History repeats itself. History repeats itself. Those that forget the past are doomed to repeat it. Those are the famous words of Karl Marx. The truth is, history does not necessarily repeat itself, but it does often rhyme. But it is true that those that forget the past are often doomed to repeat it. In my MBA program, I wrote a paper which I titled The History of US Recessions, back when I did my MBA. When you understand the history of US recession, it brings you calmness and confidence that the stock market has been structured in a way that it's actually too big to fail. We have seen all sorts of chaos over the past 30 years and go back further, but when you look at historical charts, you notice that they've all become irrelevant in the grand scheme of things. When you look at a long-term picture, the S&P generally only takes 3 years to recover all losses. So stay tuned as we dive deeper into a couple US recessions to see what the government and Federal Reserve did during these disruptive chaos moments. Remember to share, like, subscribe, and watch to the end. Recession is defined as 2 negative quarterly GDPs. That's one of the definitions. Another definition is recession is when the market drops by 20%. Hence, we are not technically in a recession right now. Let's just analyze the history to forecast what's going to happen next. During the Great Depression, there was a great economist called John Keynes. He stated that whenever there's a serious recession, we need an outside intervention, aka the government needs to step in to save the day. That's the solution. And this is what we followed throughout decades now. So now the question, are we too big to fail? All right. Have you ever wondered what would happen if the stock market completely crashed or collapsed? Would it be chaos? Would the government step in to save it? Well, here's the truth. Capital markets today are simply too big to fail. Simple as that. And history has always proven that. Right? Capital markets, right, which represents the stock market, the bond market, right, and all those fancy derivatives and that you hear about, they aren't just playgrounds for the wealthy. They're the beating heart of the global economy. That's the impact of the U.S. capital markets, right? When these markets stumble, it isn't just Wall Street that feel the pain. It's your 401k, your job, your mortgage, your business loan. All of it is connected. So that's why it's important for you to understand this information, because this stuff can make you get ahead. And when things get ugly, governments don't hesitate to step in. Let's look at a couple recessions. Take a look at the 2008 financial crisis, right? The U.S. housing market collapsed due to the subprime mortgages and stuff, bundled in complex financial products, CDOs. When homeowners defaulted, those products turned toxic. Banks stopped lending. Stock market plunged over 50%. Entire financial institutions were on the brink of extinction. So what happened? The U.S. government and the Federal Reserve stepped in hard. They cut interest rates like nearly zero. They passed the $700 billion stimulus bailout plan. They nationalized mortgage giants like Fannie Mae and Freddie Mac, and they launched something called quantitative easing, essentially printing trillions of dollars to flood the market with liquidity. M2 money supply was up high, interest rates low. They exercised all the things that needed to be exercised for things to go well. And why? Because letting the markets fail would have triggered a global depression, right? It would have triggered something beyond just the US. So it impacts the whole globe. So let's fast forward to 2020, COVID crash, recession. The fastest market crash in history, right? In just a few weeks, the market plummeted over 30%. Even the safest US government bonds were liquid. Oil prices went negative. What did policies do? Right? What did policymakers do? The Federal Reserve cut rates to zero again, right? They created an emergency lending program. Congress passed a $2 trillion relief package. And for the first time, the Fed even started buying corporate bond ETFs. Why? Because without those interventions, the financial systems would have frozen, taking jobs, businesses, savings down with it. Okay? And why does this happen? The modern economies are built on functioning capital markets. If those markets break down, it affects every sector from pension, healthcare, real estate, retail. And that's why when markets crash, governments act not necessarily to save the wealthy investors, but to prevent everyday people from losing their jobs, homes, and their future. Is this a good thing? That's the tough question. But here's the catch. If markets always get rescued, big players know they can take bigger risks. So if you know that too, you know how to act. You know why Wall Street is so wealthy. This creates something economists call moral hazard. And when bailouts happen, it's typically asset owners, people with stocks, real estate, and capital who benefit the most, widening inequalities over time. So the question I repeat to you once again, are the markets too big to fail? The answer is, for me, is yes. In practice, they are. Governments and central banks will keep stepping in to stabilize them because the cost of doing nothing is simply too high. The real question is, how do we create a system that's more fair, balanced, and resilient for everyone? Right? I want to hear your thoughts in the comment section, right? But before we even go, let's look at one more situation, the current one that we've dealt with relating to tariffs, right? The markets were crashing like crazy. Markets went down by 20%. Goldman Sachs labeled it as though we're officially in a recession, even though they pulled back their words. But at the end of the day, this seemed like a recession, right? And let's say this kept on going on and on, this whole tariff battle, tariff wars, and causing the markets to continue going down due to uncertainties. What do you think was going to happen next? The Fed was ready to stabilize things again. Quantitative easing, pumping money back into the market, pumping liquidity back into the market, M2 money supply going back up, interest rates being cut again. So regardless of what is being done, regardless of what happens, regardless of who's in power, we have the U.S. Central Bank, which is the Federal Reserve, right? Every major nation have their own central bank. The ECBs for the EU. You have the Bank of Japan, which is their central bank. You have the Bank of China, which is the central bank for China. You have the Bank of Canada, which is also theirs as well. So we have all these central banks, which here in the U.S. we call the Federal Reserve, and they can come in, step in, and inject liquidity, and by doing so, it resuscitates the market. And the bond market is also too big to fail. And that's why there's this pause and this terror, because when all this chaos was happening, certain countries, people were saying there was some belief that they started dumping the bonds. And when they do that, it's causing chaos in those markets. And the bond market is even bigger than the stock market. And so they don't want no trouble. Well, you don't want to mess with the bond market, right? The big players are going to come and say, whoa. You can play around with the stock market, but don't play around with the bond market. So basically, there was pressure really being put there. This is what they've done in history. So go back to 1929 and look throughout history and see what the U.S. government did, right? And see how they manage those recessions. And by understanding that, you're gonna have an idea what they're gonna do again. So that's why I'm always calm. When the markets pull back, people jump out. People are scared. They're frightened for their life because they have all their life savings or whatever it may be. But regardless, for me, I didn't care, because I know that even if the markets get so bad, even if the economy goes so low, they're not gonna allow it to just crash. And they have a mechanism which is called quantitative easing, pumping money, liquidity into the market, cutting interest rate, all these things. It just revives the market back again. So the central bank, that's why I set up as an independent party, independent of the government, right? So it's not necessarily the government. The government have their own thing that they can do as well, called fiscal policy. The Federal Reserve have the things that they can do called monetary policy. So remember, when you understand all this, it gives you confidence, because remember I told you, standing, right, removes fear. And so when you gain understanding, you can do things with so much more confidence. So when the market pulls back, I didn't have to jump out. People jumped out and now they try and jump back into the market again. Right? And they, and it's rough when you try to time the market in that way. So I just chill, I just relax. If I have more capital, what do? I buy the dips, right? And that's it. That's basically what I do. And there's nothing, buy low, sell high. It's very simple, as Warren Buffett says. I know our emotions are gonna trigger a lot of things, but that's because of lack of understanding. So subscribe, like, share, follow this channel so you can build understanding, because that's the key. You have to first gain the knowledge and apply it and gain understanding. And when you do that, I truly believe the knowledge that I'm sharing here on Empower Capital can make millionaires. But anyways, that's all I have for today. Like, share, comment, and stay blessed. And remember, we love you. God loves you. And stay empowered.